Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat. Paris milling wheat. 28 weeks ago, so just over 6 months in other words, I said the following, and I quote, "We may have another bearish but less aggressively bearish pattern, though not necessarily by much, is a mid-June to date bear channel," and that's currently actually at the moment 211 to 286, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering. End of quote. 9 weeks ago, the market created a cusp and we had a break higher as the bearish pressure gave way and prices surged higher, something I cautioned about 8 weeks ago. The market rose up through stratified layers of resistance. Some of them seemed and still seem quite dense, such as the congestion area 238 to 242, containing the March 2013 high at 240, short medium moving average currently at 240, also the February 2013 high today at 247, the declining medium moving average currently at 244, followed by another congestion band between 250 to 255, with the 2013 high at 253 within it. After that we had, and still have, another small congestion area between 258 to 260 with the 2011 high within it at 258, followed by a bit of a deserted area up to some of the most heavy looking congestion available between 267 to 270. All those numbers are enough to be going on with for now. The question I posed 2 weeks ago was whether the moves lower had triggered the beginnings of a new bullish movement. The weekly key reversal down back 5 weeks ago looked like the answer was for a move lower, but the response, really the action from late June to late July, ended up with a small rounded bottom pattern, and prices moved up all the way to test that super heavy overhead congestion between 267 and 270 and failed to make an impression, dropping down to the March 2013 high at 240 and the slowly rising short medium moving average currently at 242. Now, I have spoken here for many weeks about the formation of a possible descending scallop pattern. I said 6 weeks ago that this daily chart had the makings of a better example of a descending scallop pattern than in the other grain markets. However, the hesitation to form a lip, whilst fairly minimal, had affected the idea of this pattern. Additionally, the recent weekly key reversal down had helped the case for a descending wedge pattern quite a bit, but the spanner in the works had been the construction of a small rounded bottom. This, on the other hand, hindered the case for a descending scallop pattern. But unlike, say, Chicago wheat, the impact here had seemed less onerous. So for now, I will still have the possibility of such a pattern. But it will mean that what happens now in the further construction of the descending scallop pattern will be under even more scrutiny. Now, all this action since late May to mid-July allowed me last week to draw a bullish Andrews pitchfork. However, the fall last week took that pattern out of the equation, and so I finessed the pattern to a bullish shift pitchfork for the same move, which is highlighted in dark blue on my daily chart. The market's close to the lower time, currently at 238. And once again, I'm very cognizant that such a pattern throws another spanner into the works regarding the idea of a descending scallop pattern. But I'd rather say what I saw than just pursue one avenue, which might finish up being a dead end. London, UK feed wheat. The recovery rally higher from the mini reverse head and shoulders pattern formed roughly over the middle of May to the middle of June petered out in late June, with prices turning back down, not wishing to even look at the next major congestion overhead of the then declining medium moving average, currently at 190 even. However, the declining halted ahead of a dip formed from the head of the reverse head and shoulders pattern. Looking again at this drop in early July, I'm still not sure why prices went down that far, or why they halted where they did, when it looked as if prices could easily drop to the June low or even the July 2021 low at 164 even. However, this is what they did, not what I said they did. This failure to exploit the move lower led to the recovery back up at the start to middle of July, though the move up was a bit dramatic. even if it was the final part of a double bottom pattern. It was in this rise that prices met their first real obstacle overhead, the declining medium moving average again. This managed to hesitate the market 3 weeks ago, around this moving average, but 2 weeks ago prices took off again with an unusual shooting star pattern. Type 2 bullish, yes, one of those. The market rose up through the March 2013 high at 205.05, the 2022 low at 206.5, and even the 2013 high at 215 even. But it was just above this congestion that prices 2 weeks ago, and again late last week, met and halted at a significant resistance. And that's the declining long moving average, currently 213.85, along with some nearby Fibonacci and other congestions. The subsequent fall led to the construction of one, possibly two patterns. A definite small double top, Adam and Eve type, and a possible island top, though I'm bending the rules for this idea a little bit. Okay, so now I wish to look at the bigger picture as it shows some interesting perspectives onto the recent action. To start with, the action here is obviously different on this daily chart when compared to other grain markets. I also mean the chance of a possible descending scallop pattern here is different than what has happened in the other grain markets. The chance for such a pattern forming in London wheat, feed wheat, is still there, but the very recent aberrations we saw in this pattern, specifically the dip in late June and into early July, does not seem to be so influential on the overall pattern. So where does that leave us now? Well, I suspect the descending scallop pattern may be coming to completion in the not too distant future, if that indeed is what it is, or it is going to become. So the action, once again, over this coming new week and the week after, may be crucial, and that's crucial in deciding the outcome of this pattern. I'm specifically interested in whether the action for this descending scallop pattern should start from the high in February or should it start from the high in October. Now this judgment call is still yet to be made. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.